All right. Good morning, everybody. So it continues. We're just working our way through earnings. And so far, the banks are doing what we would expect them to do. Nobody's getting out of line, and numbers are coming in within range. So the markets seem to like it. The Dow is down this morning with the Russell. So we have a little bit of a disconnect between, the blue chip Dow Industrial and it's healthcare that really is separating or dividing the indexes at this point. Hong Kong is down the most. They have a big event in March. And so continue to watch China for early signs. The front running is a real big deal. And while everybody else may wait until March for the news to come out for the big event in China, a lot of others aren't, right? Especially big money. They'll get in and they'll front run the event. So you'll want to watch those China ADRs, BABA, Baidu, JD, PDD, XPEV, NEO, all of those, right? Keep your eye on them. When they seem to be at their weakest, look for that accumulation along the lows before we get to March. It's still really early, right? It's mid-January, but that's what they want. They want you to look away, get distracted, see something shiny. Ooh, squirrel. And then that's it, right? They go digging into it when you're not looking. So it's not like we want to follow the big firms. We just want to ride their waves. So we can see small caps down 0.25%. The Dow a little less than that. S&P just slightly above zero. The Nasdaq and the S&P were up more. I remember Bloomberg earlier this morning was saying the Nasdaq was up over 0.5%. But of course, they're fading back, and we have OpEx tomorrow, which, in the grand scheme of things, it isn't even really one of the bigger events on the horizon. It's just one more. We're going to get a little bit of jobs data today. This isn't the big job event that we're all waiting on, but any jobs data you should pay particular attention to, especially since it goes back to the heart of the Fed and their dual mandate. So if we look at the top, we have median forecast and then the previous number. So when we come down here, the previous jobless claims number was 201, and the forecast is for 210. Now, we don't want to see jobless claims increase too dramatically, but how's California going to hit this? And is that even going to be a part of it? I don't know. Right? It's just a question that kind of started to crop in earlier this week, and I never had a chance to dig into the answers before this morning. But I would be concerned that we see a rise in the unemployment numbers, just like we would after hurricanes or some other natural disaster. There's been times in history where the market says, oh yeah, no, it's okay, it's a tornado or it's a hurricane, these job numbers are because of that, and they don't respond to it at all. And then there's other times where we've had an economic downturn because of some hurricane or other natural disaster where they say, oh wow, look at those employment numbers, knowing full well it was the hurricane. So don't assume that it's going to be okay today. Watch the clock. It happens at 8:30, and there's two parts to this. There'll be the initial reaction, and then there'll be some digestion after we get the numbers. So that's often why we close the gap, right? It's because of that first reaction and then the follow-up. As you can see, we have a lot on the table today, but a lot of it also is hitting all at once. in 36 minutes, and then in 51 minutes, we're going to get a lot of stuff here. There's something else I wanted to hit on, but I guess I saw a squirrel. Must not be that important. I don't remember. So we had that drop in the 10-year away from 5%. There's still analysts that are calling for 5% anyways. If that's true, we're going to digest here above 4.6 and begin working our way back up to challenge this previous high above 4.8. We want to see that 10-year. First of all, we don't want big drops like this. Sure, we want it to go down, but we don't want the 10-year or the dollar ever making big sweeping moves in any direction. So let it digest here. Maybe we get a failed flag and it runs back up. That would create a really nice cup. And then maybe we get a handle on the cup, maybe not. Just like the dollar did here, where it had that nice swoon down and then developed a bear flag. It failed in that bear flag and ran back up. So it created like a cup, a little bitty handle up here. Maybe that's what we get. Or this actually follows through as a bear flag and then legs down, below 4.6. At the moment, we're on wait to see which way that's going to go. But tie that in with the dollar that also had dropped down, a little bit of a recovery. This needs to continue to go to the downside, just like the 10-year, but no big sweeping moves. So at this point, let's keep it under 109.5. I know that may seem a bit arbitrary, but with both of these, we can't just look at it and say, oh, the 10-year is going up, or the dollar is going up, so maybe the S&P has to go down. It's not working like that. Sometimes it does, and when it does, it'll often do it for weeks or even a few months, and it's fantastic when we get that. But that's not the kind of environment we're in right now. So we can't look at it as a focus on, well, that's going up, so the ES must go down. Instead, it's more about swag levels, critical levels where if it gets above or below, we're very likely going to see a response out of the market because of it. So let's keep the dollar below 109.5. I think if we get above that today, it could start to cause us trouble. And with these swag levels that we give, or these lines in the sand, they're not forever lines. Back here, we had 4.48 as a level that we needed to get back below in the 10-year. And that was important until we broke that high and continued to go even higher. And then that level was no longer important. It became 4.6. Then we broke that high and we went up even higher, right? And we have to keep adjusting. So after getting to 4.8, maybe 4.6 is still the level because of how fast we've come back down. But that's how we have to adjust things as we go. So for now, 109.5 is the level on the dollar that I'm watching. If we get above that, I think the markets are really going to start to react today. And if we can get below 109 today, then let's break this low and get back down below 108.5. I think that'll really move the S&P in a dramatic way. For the ES, though, you can see those lower highs and lower lows that I continue to talk about, and the reason why it's so important. If we can't break that trend, then we're not going to rebound. So we can see the Russell firmly inside of that candle of yesterday. We talked about that gap close situation. If we just analyze that single candle on the Russell, and I would prefer to put it on a 5-minute to do this, but we'll just stay on the 15 for this situation. That is the dominant focus. Now, it's not all of yesterday, and it's not by much, so you could just, put the Russell in yesterday's price, lay it out with a tap back. It needs to get out of the box. Same thing with the Dow. It needs to get out of the box. But if you look at something like the NASDAQ, we had the event candle, and then we ran away from it even higher, didn't close the gap, and now we've run even higher from that. Same thing with the S&P. So the Dow and the Russell are still trapped inside of that event candle from yesterday. If you're looking for a continuation today in the ES and the NASDAQ, I think you're going to need, the support of the broader market, that rising tide scenario, because I really don't see how you're going to get the options behind you right in front of OpEx. So it's going to have to be news, or it's going to have to be a collective rising tide, because it won't be options. We still have the call wall overhead. It seems to be in the same spot. We're not really adjusting it much. The put wall is up at 59.43. And having these really close together, on the one hand, it's kind of nice. It'll develop like a structure below us, so that if we come down and tag into it, we could bounce off of it, or see a lot of supportive trading behavior there and rise up from it. The other side of that coin is, with all three of them wrapped together so tightly, that if we break through all of them, say we get some negative news or just a hot flash of data, we can break through them and then get trapped underneath them. Collectively, within the volatility trigger, zero gamma, and the put wall, we have the 10-day moving average, the 10-week moving average, the 20-day moving average, and the 3-week moving average. So there's a lot of moving averages tied in there as well. Now, we don't look at moving averages as a supportive or resistive line, right? We don't trade moving averages, but you do want to be aware of where they're at, whether we're above them or below them. We're starting to lose the cumulative volume that we've been focused on, right? I've pointed out how we were getting higher highs and higher lows in this, even though in the markets we were getting lower highs and lower lows. Well, we've finally started to turn things around here. We've got a lower low, and while this hasn't fallen yet, so this isn't a confirmed lower high, it's sure looking like it's going to end up that way. The 21-day average daily range is 93 points at this point. So it's expanded to 1.55%. There's really not a lot of edge, since we're only up, 0.1% to try to discern if we're going to go to the upper edge or the lower edge. And as we're waiting on OpEx, we really don't have to do either one into the end of the week. If we can just hold the gains that we've taken, the markets would talk about it all weekend about how great it was that we stopped crashing and burning and started running back up again. So it really doesn't need to do anything else except hold the line. Look at where we went from Monday to where we are now. So, considering all the bricks in the wall of worry, keeping these gains would be considered a win in the battle on the war. It is worth noting that any move to the downside on these lower ADRs, we would still be inside of yesterday's range. While going to the upside to hit either of the ADRs, we would have to continue the breakout of yesterday's range. And we did break out, and then we gave it back. So if we're looking for an inside day breakout, we had it and it failed. 59.40 is the halfback of yesterday. So if we can start to fade more now after failing to keep this breakout of yesterday's range, then that'll be a target of interest. The thing is, I'm on the daily here on the right side chart, and I used the daily high to the daily low. But oftentimes going intraday and marking only the intraday can give you insight that you can't get from the daily chart. So here's a halfback, 59.76. And then 59.40 as another one. Well, 59.42 is the ADR on the downside. 59.40, 59.42. Yeah, it's close enough. Same difference. 59.50, a nice round options number, is just slightly lower than the RTH of yesterday. And again, that's also close enough. 59.92 is a cog line. So if we break 92, we'll look to run it to 76. But to get to 76, we got to get through our own Globex low at 82. So step by step, level by level, break 92 to 82, 82 to 76, 76 to 50, then 40, yada, 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 on down we go. Just keep in mind, we've got economic events this morning, and a lot of them. We are above the weekly pivot point, which puts us in a bullish bias on the week, and we're moving farther away from that weekly pivot. Today's daily pivot is significantly higher than yesterday. That's considered bullish. Price opened above today's pivot. That's also considered bullish. And we have an MDP, but it won't count today. MDP is missed daily pivot. It's as simple as it sounds. The floor pivot here, we haven't hit it. 80% of the time, a market will hit that pivot point during the day. So when it doesn't hit that pivot point, we call it an MDP, and we use it in our analysis for tomorrow. There's some really good videos on YouTube if you want to go check them out. They're not mine. I didn't develop this concept, and it is a strategy, but I don't trade it as a strategy. It is like a lot of strategies out there. It's just really good for analysis. So the expectation is that if we break our own Globex low, that will be one of the destinations and be a target. And to me, since it lines up with this low in the RTH yesterday, it wasn't the best low because we had that wick too. But structurally, that was the better low of yesterday. It lines up really nice for a target to the downside if we break our own Globex low today. On SPY, 598.3 is today's one standard deviation to the upside, and 588.5 is the one standard deviation to the downside. That's a 10-point wide move in SPY. How you like those apples? We've got two distributions now on the week's profile. The one that we built Monday, Tuesday, and Wednesday down below with the point of control and the one that we're building now. It's very likely that if we stay within this range that we've developed in the overnight hours, we'll actually bring that point of control up by the end of the day today, which is interesting if you think about it. It took 3 days of developing this point of control down here, and perhaps within 24 hours, we will have moved it all the way up to these highs. Whether we move it up there or not is one piece, and then whether we are above it or below it by the end of the day, it's going to be another piece. And it is for the week. So we'll see how it builds out. We made it through this structure back here, 59.47 or 59.50. We have one more overhead. It doesn't seem like much compared to this previous one, but anything that we could hit, you want it on your radar. 60.27, 60.26, right around in there. Otherwise, a move to the downside, we would very likely fall back through that fast move that we made. So if we break 59.50, we can go back to 5,900 really fast because of how shallow that is. There's nothing really there to catch us. Ten-day, 30-minute volume profile with TPO. They really don't look very similar at all right now between the blue profile and the green profile. They are lined up with their point of control. However, it looks seamless, perfect. It is below us. We need to keep it there. If we go back and visit it, we could get stuck around it, say like we did back here where we just, hovered and gravitated back and forth above it and below it. But for the most part, we want to just try to stay away from it. We're not expecting to see this point of control move anytime soon. We built this thing out because of the volume within this last week here, not from Thursday and Friday back here. So we're going to lose these candles on the far left. It's likely not going to make much adjustment to where the point of control is. Next week, as we start to build out more volume at another location, then it's very likely we'll see the point of control move. And at this point, it's a toss-up on whether it will go lower into 58.60 or higher into 59.90. But it won't be where it is now. We'll take that off the table. So we hit this VPOC from yesterday. It's a line that we had since January 7, 59.77. So we've taken that off the table. We're done. And if we were going to put a new one on today, it's already been hit. And we were talking about this one yesterday. And the idea is if you go through the textbooks and learn, TPOs and volume profiles, they will recommend that you carry forward these points of control every day. They don't distinguish between whether or not it's been hit or not. They just say, take yesterday's line and plot it into today's price action. The same with this value area high line here and this lower one here. Now, I've got enough pivot points that I don't need any more. Really, I've got more than enough. But if you want to add some structure to today's trading levels, right? If you want some structure around price, it wouldn't hurt to dig deeper into understanding how volume profiles work or even TPO profiles if you want to go that route. And they do offer insight, not excluding the fact that even on your own intraday, you can have a volume profile and a TPO. So you have yesterday's and today's. They do provide context and value. I don't need them. I have already got enough. This line that I carried forward for today, it's not a VPOC. The V is virgin or untouched, right? And it's been touched. We came down and we hit it. So if I was to carry it forward, I would just mark it as a point of control, not a VPOC, and then distinguish it in some way differently from my regular one so I don't get it confused. I'm going to go ahead and mark it for today because we're really close to coming into contact with it again, even though we came down and hit it earlier. Let's see if there's any reaction there. But generally speaking, I don't carry them forward unless they're like this down here, where we closed on that day. And since then, we haven't come back to that level and it's still untouched. If you trade equities, that's really useful too, by the way. It's not just something that you can do on futures or even on ETFs like SPY and the Qs. We are completely outside of the range for the week. We're supposed to close inside the lines statistically 68 point blah, blah, blah. We just round it up and say 70% of the time we should close inside the box. But the S&P has the most accurate expected move out of any product in the marketplace. So even though the numbers say it should close inside the box 70%, the history shows that it actually does it about 80% of the time. So we've got an 80% chance that it's going to fade back down and close inside this range. Make no mistake about it, though, there's been many times throughout history where it does not close inside the range. Now, when it happens once in a while, right, it's not a big deal. Say 1 out of 10 weeks or 2 out of 10 weeks would still give you your 80% and 90%. But if you can count back 10 weeks, not counting your current week, but just count back 10 weeks and don't count broken ones like this one. There was something wrong that week and it was just a crazy, super scrunched up line. There, the indicator wasn't working. That was the contract change event week and it was just broke. So don't count a broken week. Count back 10 and how many weeks you find where we closed on Friday outside the box. If you count more than 2, well, then we're not meeting our 70 to 80% ratio. And it's usually a really big warning. Like before COVID hit, we were breaking outside the box and closing outside the box numerous times right before COVID. Same thing when we started getting into that bear market back in 22. We started breaking the weekly expected move on the week repeatedly. When volatility increases significantly and they're not pricing it into the width of the spread of the week, then price can exceed the volatility expectations and we close outside the box. I believe I have this weekly expected move in the Thinkorswim workbook with a weekly counter on it as a label up here. It'll just tell you how many weeks in the past, whatever, that we've closed inside or outside. I don't use it because it can get confused on weeks like this one that was broken. And I consider this week another one of those broken weeks. Sometimes the indicator just goes goofy, right? It's a Thinkorswim thing. So I don't run the automatic one. I just count them myself. But if you want the automatic one, just look in the Thinkorswim workbook. You should be able to find it. We're back above the 10-week as we talked about yesterday, just working through the cycle. We dip down, run back up. It is concerning if you think about the trend of this thing, how it's been moving lower and lower, meaning our sweeps back above the 10 before we turn around and move back again has been shrinking. Think about price action and its sine wave. Well, it's supposed to be one, equidistant, and two, we think about trends. If you break out and start running in a trend, and then you pull back, you break out and continue to run, you pull back, break out, and continue to run. You measure each one of those. How far did the run go before we paused and pulled back again? That's basically a look at what we have here on the 10-day, excuse me, the 10-week, where our sweeps above the 10-week before we pull back again, they've been shrinking. We look back at the start of 2024, getting above 4% was not such a big deal. We were doing it frequently, getting to 4, 4, 4. Then it was, well, we're not quite making it to 4, but we're above 3.5. And now more and more, it's getting to the point where just getting and staying above 2 seems to be an issue. But we are on the move back up. That can be short-lived, like we have here in the middle. We came up and we just went right back down again, or it can stick around for some period of time, like we have back here for an example. We're back above it. That's just a start of the good things to come. Nothing good about being underneath the 10-week. As for the 10-day, same thing. We're about 0.5% above. It's a lot more choppy here. We've been spending way more time below than above. We need to hold above the 0 line and bring the average back above the 0 line. This average is a 20-day average. That's what that blue line is. And it's an average of us being above or below the 0 or the above or below the 10, and by how much. We need to get that back above 0. Right, certainly energy did really good on this reversal and run back up. Building materials also looking, all things considered, building materials made some really good moves, especially for a sleepy, boring one that's not supposed to move that way. And then you've got industrials. What seemed to be a little more disappointing was the move in tech, finance, consumer discretionary. So we want to see more out of those three. Those top lines are the risk on sectors that we really need. And we're already starting to see crude. It was down 1% this morning. Watch for those names that fit in the crude space to get whacked a little bit. Remember, crude's not a forever trade, right? It mostly stays range bound because that's where we need it to be, is range bound. If it gets too expensive, then people fill it at the pump, and it really affects companies and corporations. And if it gets too cheap, then oil and gas companies can't make enough money by pulling it out of the ground. Now, I worked on those drilling rigs for most of my life, and I'll tell you, they own what's in the ground, right? And if they can't get it at a good, fair price now, they'll just leave it in the ground because they can get collateral from the banks, right? They can spend what's in the ground without ever having it in their hand. So they don't care. If it's too cheap, they'll just leave it down there. Well, if they do that, that affects their earnings, right? Because their shareholders won't care that they can borrow money. They just want to know that they can make money. So at the end of it all, crude has a range that it needs to stay in. And we've reached about as high as on the range as we'd want it to go. It won't break if it goes a little higher at this point because we're not at the extreme edges of how high crude can go. But it's at its common stopping point at this part. Looking at what's down this morning, we got Bitcoin down. That thing moved 6% in the last 5 days. Pulling back just a little bit kind of makes sense. We started to see some Bitcoin reserve talk again. This is a big deal. This idea of a Bitcoin reserve, a U.S. federally backed Bitcoin reserve they're talking about 1 million Bitcoins being bought by the government in chunks of 250,000 coins each. You know what that's going to do to Bitcoin? No joke, right? But it's not approved yet. So they're still fighting about it. And then, we can't get Congress to agree on anything. So if it has to have congressional approval, and well, good luck with that, right? So when there's whispers about it and new headlines on it, Bitcoin gets a little bit of love and then it stalls out again. But that is why it moved so much already. And analysts are projecting 400 to 600,000 as price targets eventually in time, right? Same way as the Federal Reserve of gold. Well, if you look at gold, how much it's moved over the years, and we're at what, 27,000 now. 50 years ago, you weren't thinking 27,000 in gold. It's a tomorrow problem. Just keep your eye on Bitcoin. This is likely just a pause after a really nice run, a 6% run, but it needs to hold in that pause. We don't want to see it giving up too much of those gains. Airlines are down, but not by much. If our benchmark is 0.5%, then they're not there yet. Really, the main one is that the VIX is down 12%. Crude is down. Bonds are down. Bitcoin, that's about it. Looking at what's up. Semiconductors, so the chips are up. And really, that's all we got. Chips in China. So SMH has been fighting this 260 level for a long time. We seem to get above it and get rejected, and get above it and get rejected. And here we are again, fighting that same level. We didn't even get there yet, and it's already started to fall. Get that worked out. See if we can get through this 260. There is more to offer eventually. We just haven't been able to get there yet. The range is relatively easy to see. Shouldn't have any issues with that. I already had a couple people asking about this. The idea would be to try to get in along the lows, right? And I know that sounds like a Captain Obvious statement, but when you ask me about a trade and it's at 250, about going long or short, and you miss the bottom and there's not much room to go except the top, then sure, you can try to run it from the midpoint to the top. But how many times this thing, fell to the midpoint and then went back up again, or went to the midpoint and fell back down again? If it's in the middle, you've got a 50-50 coin toss that it's going to continue to move to the side that you want it to go to. You're better off playing against the edges. So you could look at this and say, it's not at the edges. I don't have a play yet. Otherwise, sure, take risk. Give it a shot. But that's all it is. You're just rolling the dice. You can go to Vegas and do that and get free drinks. Pot stocks still not going anywhere. There were some headlines as we get into the new year. Every year we seem to see these headlines about this is the year for pot stocks, and they bring up those alcohol companies that are mixing with the pot stock companies and trying to come out with new products and beat legislation and blah blah blah. So we're still not getting much out of these. They get a little bit of a bump on any sort of headline about legislation, and then they fall back out again. They're definitely not ready. So they're up this morning, but what do we got? One single candle, very likely on one headline, and it's just going to bleed back out again. It's another pot stock. Retail up a little bit. Target had good numbers. The turd is floating. Imagine that. I wouldn't expect much out of Target yet. Still got a lot of work to do before it turns things around. That is broken. This really big liquidity bar marked the 50%. Until it can get through that 50%, then it's broken. But that did give a lift to the retail ETF. Just like the healthcare names smacked down the Dow this morning. Home construction getting a little bit of a lift. There's been a lot of talk about the California fires. If you go to social media, even for 5 minutes, you should see the amount of backlash against the California government on the red tape and regulations and the dirty tactics on the chances of anybody being able to rebuild the homes that they lost. So sure, home construction, home builders, and companies like Lowe's and Home Depot, you would expect them to do good after a whole bunch of homes got wiped out because people are going to want to rebuild their homes. Thing is, it's looking like people aren't going to be able to do that anytime soon. There's just too much government red tape in the way. So these companies are likely to get a little bit of a bump, but it's likely just going to be sold off again afterwards because the bump is from people who don't understand that this isn't going to play out the way they want. You'll know when the institutions start getting into it. All right, well, we covered crude. It's not hard to see that range that we've been talking about. Around 85 is the sweet spot. Sure, we can get into 90s, but you don't want it above 90. And Bitcoin being down a bit. That was a nice move in bonds yesterday. But now that we've made this initial move, it needs to keep the half of yesterday. It's kind of the line in the sand. If we're going to turn this around in bonds, and there's a lot of room for us to work our way back up, the first step is going to be keeping above yesterday's halfback. I don't expect it to get nasty today, but if we do start making moves to the downside and we break through those other two halfbacks, we have all of the move for the week, right? For this whole run up that we can measure. And the halfback on that is 59.05, just above 5,900. So, if we get through 59.11 cog line, then it's very likely we're going to test 5,900. If we break 5,900, then we're headed to 58. I don't think it's going to get that nasty today, but it's all going to be headlines and any one of these banks can say something the market doesn't like. So continue to watch the clock, keep your eye on the news. Remember that the bigger events are still on the horizon. We've got a list, right, that I've been kind of checking off. . job numbers, import, export prices, and then OpEx with GDP projections tomorrow. And then we go into a 3-day weekend. So what I got for you guys, be careful, be safe. I'll see y'all tomorrow.